Let's now have a discussion about our views, or your views, Jonathan, on equities and bonds, which we've kind of already touched on. So let's first start with equities. I think you said earlier you believe in the short term we've got a period of consolidation, which generally means markets will trade sideways, maybe with a little bit of downside volatility. We talked about the fact, I suppose, or the notion that PE ratios and valuations on stocks are pretty stretched. They're still pretty stretched. They were stretched before the drop, a bit more stretched before the drop, but then we've had downward earnings revisions since. So, what's your sort of outlook and positioning on equities globally and then possibly in Australia?
Yeah, I would net. I would still be somewhat defensive on equities. I think that that massive decline, then the rally, it happened very, very fast. So I kind of understand. I think a lot of investment institutions, I've actually spoken to people on both sides of that trade. The kind of fast money hedge fund community were very aggressive. A lot of institutional investors just went, "Whoa, that's," they took a step back, and the market fell so fast. I mean, we nearly had trading limits, circuit breakers, on 2 consecutive days. There were 2 days really where this thing really fell apart. And then I think people were kind of saying, okay, we have to reassess the situation. Then the markets just bounced back. I think your observation about valuation is very important. The valuations are still have to be, it doesn't matter if you're a bull or a bear. If you look at history, the price earnings multiples in the United States are still on the expensive side of their long run average. So that's an observation of valuation fact. The earnings side of the equation, we've seen that sharp downward revision for EPS, earnings per share estimates for calendar 2025 for the S&P 500. And we're probably going to stabilize around these lower levels in terms of earnings EPS numbers. And so there's kind of is EPS going to be revised up sharply? I don't think so, because now the Fed's on hold. The other thing, which we never talk about in the US anymore, is the housing market. The thing is almost frozen. That's a big engine room, which is really flat and very quiet, actual housing activity. The other thing is, did you know that tourism is 10% of US GDP? I did not know that. That's a really big number. A lot of people from all over the world travel to the United States. And we're seeing a lot of bookings come off, holiday bookings, flight bookings, so on and so forth. Now, we know that tourism from Canada to the United States has collapsed because Trump was ridiculous by declaring that Canada should become the 51st state. I wrote about that in my report. I mean, that was just nonsense. You can understand some of what Trump is doing, but just to declare Canada as the 51st state of the United States, I mean, no wonder the Canadians got upset with him. I mean, what a big surprise. And by the way, Trump made Carney prime minister. The Liberals were 25 to 30% behind the Conservatives in the Canadian election until Trump started talking about Canada as the 51st state. So what I'm trying to say is there's a huge collapse in tourism from Canada to the United States. These are very big, powerful trading partners, and a lot of damage was done to that relationship. In Canada, I have friends in Canada, they were going to their local store and going to supermarkets, big stores, and the owners, the proprietors, were removing US produce from the shelves. It was serious. Now, some of that will die down a little bit, but then there's also the European-US relationship as well. So at the end of the day, we've got to take a little bit of a step back here and say, hang on, some damage has really been done by Trump unveiling Liberation Day tariffs, but also his rhetoric around Canada, his rhetoric around Europe, declaring, and I listened to the speech because when I read it, I thought I have to hear him actually say it. He declared that the European Union was created to rip off the United States, to take advantage of the United States. And then he said, and they've done a really good job of ripping us off. Now, that kind of rhetoric kind of angered Europe. And we know what the Europeans are doing in terms of NATO. They're increasing defense spending. And there is a sense amongst the global pension fund community. This is important. We know that the Europeans massively increased their exposure and investment to US assets, financial assets, particularly equities, in the last 5 to 7 years. The numbers are dramatic. Many trillions of dollars flowed from European long-term, long-only institutional investors into the United States because we had the Magnificent Seven, we had US exceptionalism. And if you look at the capital flow data, the portfolio flow data, the numbers are staggering. I think, don't quote me, $7 trillion increase in exposure in US financial assets from European long-term investment accounts in the last 5 to 7 years. I know from talking to people in Europe that they have looked at their portfolio construction and they've gone, oh my goodness, we are so overexposed to the United States. We actually don't really know what's going to happen next, but we feel uncomfortable having 67% of our total portfolio in the United States. So we're going to pare that back to 65, 63, maybe 61. Now, these pension funds move very slowly. They have long investment committee meetings, take a long period of time. But I hear that from quite a few people in Europe. So what does that tell me? It tells me that, you know, just be a little bit cautious on the United States. You said it yourself, the valuations aren't exactly cheap. Funnily enough, Eugene, just in the last week, I've been looking at the various sectors in the United States. And, you know, the one sector that will, I think, be one of the bigger beneficiaries of this reversal of these ridiculously ludicrous high tariffs that Trump was kind of talking about is actually smaller companies. So it might be more of a tactical play, but the smaller company index, as you know, has underperformed the rest in the last couple of months. And I think that might actually play a little bit of catch up. And also portfolio managers that are looking to try and do something now that we've got this new event, this new news out of Switzerland and both China and the United States pulling back from an effective trade embargo. You might see some allocation into smaller companies. So that looks like, I think, a relatively bright spot in the next couple of months. With regard to the Australian market, you know, we did a similar kind of thing here. We collapsed and then we've rallied. And I see a similar kind of consolidation here. Yes, the RBA cuts, but then the market's going to have to price my apologies, a fairly long pause from the RBA as the RBA digests the fiscal ramifications of a very, very large Labour majority in Parliament.
Yeah, okay. Thank you for that. And then bonds, and we've sort of touched on it earlier. What are your thoughts on bonds?
I'm still cautious on the long end of yield curves. I have been for a while. I was very much part of the yield curve steepening community. I'm kind of still on that train. I understand the rhyme and reason and logic behind the steepening of the curve because, of course, the United States has this massive refinancing requirement because they're running a large budget deficit with vast amounts of government debt. And so as we move forward, the United States Treasury has to issue a vast amount of securities to finance that continuing budget deficit. And therefore, that will put all things equal, upward pressure on particularly long-term yields. We also know that Janet Yellen, I mean, I can say this, I think, she's no longer Treasury Secretary, was very, very, I think, irresponsible in basically the majority of the issuance of US debt was in very short-term securities, namely US Treasury bills. And now we've got a situation where there's a disproportionate amount of outstanding US government debt that has very short maturities. But the problem with short maturities, they have to be refinanced sooner. And a lot of that refinancing is happening over the balance of this year into next. And wait, if you do the maths, and the CBO has done it, and every hedge fund, global macro hedge fund, has done this calculation, and I know Scott Bessent has done this calculation, that if we refinance all of this debt for the remainder of this year and into next, above 4% yields, above 4% long-term yields, your interest bill is going to skyrocket. Now, it's already $1 trillion.
Yeah. And you're going to see this in a lot of places, but I think the US you're going to see this, you know, for the next 5 or 6 years, unless rates come down significantly, because a lot of these loans were at, you know, 0 to 1% interest rates, right? Leading into the repricing in 2022. All right, so we're cautious on long duration bonds. So to summarize your view, you're cautious on duration. I think in our discussions, you've sort of expressed that whilst you're cautious on it, because the yields are now at sort of 4 and 4.5, and maybe even approaching 5%, depending on where you're at on the yield curve, because you're getting that yield, you're not worried about, you know, the sort of losses that you were seeing in 2022 and 2023. So it's still worth having some in the portfolio, but you're underweight and at the very least cautious. And in terms of, is that an accurate representation of your view?
That is an accurate representation, because you and I have had these conversations over a long period of time. The great thing about higher nominal yields is your starting point is higher.
Yeah.
So it's higher. And so basically, you know, you've got more kind of cushion. If yields rise, you're still getting a reasonable coupon or fixed rate of return. So there is a greater sense of immunity to rising yields. But yeah, I'm more disposed to the front end of the market. And also, I think you can have allocations to credit. I would be somewhat wary of high yield.
Yeah.
And I've expressed that before, but I think there's a case, an argument to be made for an exposure to you know, higher quality credit.
Floating rate. So credit that doesn't have long-term fixed yield, right? So we call that floating rate credit or short-term credit. But the emphasis is on quality. I don't think this is the time to be going into junk bonds or high yield. Our view is that we want to have investment grade, good issuers. There's probably better value in Australia, and probably the yield risk for duration is not as bad in Australia as it is in the US. But yeah, quality you want to have, and I think that's across everything. And emphasis on quality in a period where valuations are stretched. There's a lot of uncertainty around interest rates, inflation, and what governments are going to do from a fiscal point of view.